Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We had him on about a year ago, I believe, to talk about value investing and how a value investor looks at the markets. He's the author of The Little Book of Sideways Markets, How to Make Money in Markets That Go Nowhere, and also Active Value Investing, Making Money in Range-Bound Markets. He's the Chief Investment Officer at Investment Management Associates in Denver. Thank you for joining us back on Wall Street for Main Street podcast, Vitaliy Katsenelson.
It's my pleasure. Thank you, Jason.
Now, Vitaliy, let's talk about the margin of safety, because we talked about that quite a bit on the last podcast interview, and you referred me and our listeners to the Seth Klarman book, Margin of Safety, and I skimmed through it, and it has a lot of valuable information there about CapEx, maintenance CapEx, things like that, and how to find a good long-term investment at a reasonable valuation. My question to you is it harder in the last year that we spoke for you to find a good long-term investment now at a reasonable margin of safety?
Well, the market is up probably 30% since, so it's becoming increasingly difficult. We are doing a little buying and we're doing mostly selling now, just because it's the more stocks are becoming fairly valued and overvalued. And finding what's difficult about today's environment, it's not just finding undervalued stocks, but you want to find stocks whose earnings power will stay or grow over time. And this is a very important point, because the earnings you see today may not be earnings that are going to be sustainable 3 to 5 years from now. And that's what we're looking for, because a lot of those earnings are inflated by what the government is doing, stimulus in the United States, in China. Also, they're inflated by very low interest rates. So we find cheap stocks, but we find that they are cheap enough once we stress test their earnings for other external factors.
Yeah, I would agree with that. It seems to me, Vitaliy, and you can tell me what you think about the way I see the markets right now, is that a lot of these large publicly traded companies, they can't really grow the top line. They're struggling to come up with new products or services to grow their revenues, and either they're taking that cheap debt, like you mentioned, and they're buying back their shares to manufacture or financially engineer, if you will, higher earnings, or they're now have started either in the food industry or pharmaceutical industry, they've started to do massive amounts of leverage buyouts and things like that. Is that what you're seeing as well?
Yes, and also you're making a very good point, because you see these companies, when you can grow top line, the first thing you try to do is cut costs. These companies already did this, right? Then you try to do a buyback stock, but you can only do so much of that. Then the latest, I guess, two types of attempts. One was to do inversions, which is basically try to lower your tax bill by merging with a company that is foreign. So that was one attempt. Another one is basically one company buying another and cutting costs. So you already cut costs, but if you hope you buy another company and you take out redundant costs. That's basically what happens. Well, first of all, a lot of it happens usually at the market tops, though this is not me saying this is the market top, but historically that's what happened. But also, this is when you can't find organic ways to grow. Acquisition is a kind of not necessarily a great substitute for that, but it is a substitute.
Yeah, and exactly. And when the capital is cheap, Vitaliy, there's going to be the incentive, and I think the Federal Reserve and the other global central banks that have made the interest rate so cheap, they've given the people who are running the corporations, the chief financial officers, the CEOs, the incentive to go out and do acquisitions because the capital is so cheap. So I think...
It's kind of funny. The word accretive acquisition, that's what you hear every time they make an acquisition. And it sounds great, except it's only accretive when the interest rates are 3%. So it's only accretive when your cost of capital is as low as it is today. It may not be necessarily accretive if the interest rates come back to their normal, semi-normal level. And I think that's an important point.
Yeah, I agree. Now, in terms of finding value in the stock market, what's your opinion of foreign stocks in developing markets or resource stocks? Because I've talked with other value investors, and they're starting to look there, whereas in the past they may have not looked at developing market stocks or resource stocks.
Well, resource stocks, I was concerned about them for a while. And you might argue that my concerns already played out because a lot of them have declined. But if you look at Chinese economy, they're still building. So the resource stocks basically future is going to depend on what's going to happen in China. And I think China's story, China overcapacity hasn't played out yet. So, if China slows down substantially, the iron ore prices, and the oil prices, all those things, all those commodities will decline probably a lot more than they have declined so far. Because we were in a basically 10, almost 13 years kind of commodities, super cycle, and that super cycle doesn't end like just in 1 year. Let's say. So I'm not looking. I'm not looking at the. Maybe they'll kick me out of the value investor, club or something. But I'm not looking at those beaten down resource stocks yet.
Okay, because we're even starting to see Warren Buffett start to look at some of these resource stocks. I mean, he's bought Suncor in the last year and a half. He bought the railroad stock, which connects the shale oil, moves the shale oil, and then he just started buying a lot of ExxonMobil. And he's also been buying John Deere. So what I would say for the counter argument is you brought up very valid points about China, and I agree with most of them. I think like the base metal growth, the copper, the iron ore, those types of things, the steel, those things, there's drastic overcapacity. But the thing I like about food and energy is it's consumed and it's not recyclable. So I think there really is a middle class, a Chinese middle class that's moving from, these older, poorer cities to nice, newer cities with newer infrastructure, and they're going to want to eat more calories. They're going to want to eat more protein. They're going to want to drive a car for the first time. So I think there's less downside up to food and to energy and agriculture than I think what you're thinking.
Well, the food is not a hard commodity, it's a soft commodity. So I was talking about these hard commodities. When I was, so John Deere, as you mentioned. So in other words, if you ask me, would I rather buy John Deere or Caterpillar, I would say John Deere, right? Because I agree with your point on the food. I'm not quite sure if where we are in that cycle, but I know that hard commodities, and that's what Caterpillar is exposed to, have a long way to go down, before Caterpillar will become attractive.
Yep.
So,
I agree.
And by the way, Buffett buying railroad, the shale boom in the United States has very little to do with with oil prices. I guess we'll still be producing oil probably at $7 and $8, and so we're still going to be transporting a lot of oil on railroads. But though I would argue that $40 oil, if prices fall to $40, probably Buffett's investment in railroads will not look so great. But I could be wrong.
Yeah, I actually agree. I've spent a lot of time looking at production costs for these shale oil companies. I've interviewed newsletter writers who cover nothing but the shale oil companies, and basically if the shale oil if the price for WTI, if it drops to like $65, $70 a barrel, these shale oil companies are not going to have any type of profits. I'm not sure if you've looked at the balance sheets of some of these guys, but they're not really generating free cash flow even at these prices because they've been growing debt faster than they've been growing revenues and not generating free cash flow for the U.S. shale oil producers, most of them anyways.
Well, that's kind of typical for like when those companies are growing, they usually take all the cash flows and reinvest them back in the business. So the question you have to ask yourself, what is kind of a maintenance capital expenditures, right, versus for growth? And that's what you have to differentiate when you look at the kind of their free cash flows. So in other words, how much money they have to put back into the business just to maintain this level of revenues. And so anyway, but that's
a great point, and Seth Klarman brought that up in his book too. I remember reading that. Yeah, and the one thing about the shale oil producers, whereas in the past you had the oil producers who they would drill one hole right straight down, and it was a gusher, right, like on the TV shows like Beverly Hillbillies, and it would just start gushing like Spindletop for a long, long time, and you wouldn't have to re-drill it. The shale oil companies have to put more maintenance capex in, like you mentioned, which makes me worry about them as a long-term investment because when they're putting more and more money just to keep the production growing or keep the oil production at the same levels, that's not a free cash flow generating business.
Exactly, and I usually, I don't want to be dogmatic about this, but I rarely invest in the oil companies in general. For this reason, for many other reasons as well. Because they don't, as a shareholder, you rarely see money returned to you. They always, every penny they generate, they put it back into the field to try to grow. So.
Well, what about developing market stocks, Vitaliy, or European stocks? Are you wary to invest in Europe right now, or in like Brazil for consumer companies in Brazil or other companies?
You know what? We haven't spent a lot of time looking at Brazil, but we do own quite a few European companies, and or we also own, like, I guess Norway is Europe too. So we own one of our largest holdings is a Norwegian company. I'm not going to mention the name, and it's a very, very cheap stock. It has a very high yield, a great balance sheet. So if I can find high quality company that meets all my criteria, I would love to buy it. If it's United States, great. If it's in Norway or it's in UK, I'm fine with it too. I'll be honest, we just haven't spent much time looking in Brazil. Though we are looking at a company that has a lot of exposure to Brazil, but we're still doing research, so we haven't made up our mind on it.
Okay, I was just using Brazil as an example of the developing world and see if you're willing to take risks in other countries besides maybe the U.S. or Europe. But for me, when I've looked at valuations on companies, like at least here in the U.S., the large caps, seems like a lot of money has flown into the U.S. Capital has flown into the U.S. from Europe and Asia, Japan, China, and it's been buying up a lot of large cap U.S. dividend-paying stocks and causing higher market multiples that I don't think are justified.
Actually, you make a great point. I just wrote an article about this. It hasn't been published yet, but I talk about the stocks. They're basically kind of a bond substitutes, right? So people look at them and they basically don't look at valuations anymore. They just look at their dividend yield and say, well, this 2 or 3% dividend yield is better than I get in the money market, so therefore I'm going to buy it. The problem is, if you think about the stocks for a second, they're almost like a long duration bonds. Okay, so if interest rates, so you buy an overvalued asset, and so when interest rates go up, they're going to get crushed because suddenly people will discover, well, if I can get a 4%, 3% in the money market, why do I need to own, I don't know, Coca-Cola that yields, I don't know what it yields, 2 or 3%, right? So those stocks will get crushed because they basically became kind of a bond substitute. They almost have a linear relationship with interest rates now. Also, there was another group of stocks which have a double linear relationship with interest rates, and those are kind of REITs and a lot of MLPs. And I'm generalizing right now, but a lot of those companies, in addition to people being buying them just because of the yield, they have a very leveraged balance sheet. And as a part of their ongoing business, they need to have a leveraged balance sheet. In other words, a real estate investment trust that invests in apartment buildings or office buildings, they cannot be 100% financed by equity. Just return on capital would not be there. So they need to use debt, right? So when interest rates rise, their cost of, so first of all, their multiples would get compressed. But more importantly, their earnings will be impacted because suddenly they're going to have to refinance at some point when they're at much higher rates. And so they're going to have kind of a double impact, in the rising interest environment. So I would caution your listeners to be very, very wary of those companies. So it doesn't mean that you should say go out and sell every single company. That's not what I'm saying. I'm saying this is the risk that you want to stress test your companies for.
Now, in terms of profit margins, Vitaliy, you've written extensively about mean reversion and profit margins in the stock market right now. I think we're at an all-time high. Do you think it's sustainable then for these management teams at U.S. corporations to keep figuring out new ways to cut costs? Are new technologies going to come and keep drastically cutting costs? And is that the way then that the higher market multiple is going to be justified by like the people on CNBC and Bloomberg?
The people that basically say those high margins are sustainable forever because of technology, don't understand how economics, how competition works, how economy, just plain economics works. So before I go there, let me just give you one very simple point. If you chart GDP growth over the last 100 years, GDP, and you chart corporate profits against GDP, and take last 100 years, there were periods of time where corporate profits grew at a faster rate than GDP. And every single time, after that, corporate profits grew at much slower rate than GDP. You can't, historically, earnings grew at the same rate as GDP because every time profit margins got very high, profits what followed was a stagnation or decline of profits. So that's point number one. Point number two, I wrote about this in my book. The technology, today you can argue that companies are a lot more efficient. They have Oracle software, they have SAP software, they can manage their workforce better. And you would think that would result in higher profit margins. But the problem is that technology is accessible to everyone. And therefore, if your company became more efficient because of use of software, so did your competitor. So those excess profits will get competed away because of competition. Also think about it this way. Access to technology became universal. So like in the 1980, let's say take 1980, Walmart at the time was very, its competitive advantage was many other factors, including it was very technologically advanced, right? So at the time, access to technology was its competitive advantage. That's not, and so if Walmart would have just basically kept, so the Walmart was able to charge the same price as everybody else, but have high profit margins. Not, but so if Walmart did this, its margins would have been 25%, but not 3% what they are today. So those profits, so now Dollar General, the much small company, has access to the same technology as Walmart, and therefore, guess what? Walmart gets beat out by Dollar General now. And so Walmart cannot charge high prices in Dollar General because technology is not its competitive advantage anymore. So my point is, profit margins never stayed at high level for a long time. They always decline because they get competed away. As Jeremy Grantham put it, that happens because capitalism works.
Exactly. Yeah, I've read that piece from Jeremy Grantham. I think I read it. You put it on your website, and then I read it. In terms of the profit margins, like a great example for our listeners out there is Apple. Apple was on top. They had so many winning products in a row with Steve Jobs, with the iPod, the iPhone, and the iPad. And, they were slow coming out with new products and things like that. They did have a very wide moat with their ecosystem and their iTunes network and things like that. But, Samsung started to creep up on market share, and Apple's going to have to keep innovating, right? Because they're a technology company. They're going to have to keep innovating to maintain their high profit margins, and those high margins are very attractive to competitors to want to come into the business.
Yeah, and also, again, when you have this kind of conversations, you and I are generalizing, right? Because, so some companies will be able to have high profit margins because they have a competitive advantage that is durable, right? And but other companies won't. So I just want to make sure that you understand that this we are generalizing, and there are exceptions. Yeah.
Now, I want to talk the last part of the interview. I want to talk about Warren Buffett and other value investors. You wrote an interesting article to your email subscriber list about Warren Buffett and how he wrote about the Coca-Cola shareholders. The Coca-Cola board of directors, how they were paying themselves excessive stock compensation plans, but yet Warren Buffett didn't really voice his opinion. I guess he sat it out and says he was indifferent about it. Why do you think he didn't objectively say, you know what, I don't want to own this company, I'm just going to sell my shares if the management team is going to take a lot larger salary and a lot more shares than I think they deserve?
Yeah, so let me just clarify a few things. So what happened was Coca-Cola filed a proxy where they basically spelled out compensation for, not the directors actually, for management. And David Winters, who manages the mutual fund, came out against it and said that's too high, just giving out too much of a company to management. And he's so when then Warren Buffett came on CNBC and they asked him about that, and he said, yes, I think that's the compensation of Koch's management is excessive. Buffett did like the company, he did like the stock. He just said this management is getting paid too much. However, what he also said, and this is what really ticked me off. He said that he's not going to vote against that plan because voting against Koch is like voting against America. And I thought this is the most un-American thing Warren Buffett said, because be able to express your opinion and not be not worrying about being prosecuted. That's what America is all about in my mind. So the Buffett basically did not like the plan, but he did not want to vote proxy against it. And you can argue that he probably did some lobbying in closed doors, not in public, for the compensation plan to be changed, which it has been changed by the way since. But I would argue that Warren Buffett is judged by double standard. He's judged by double standard because he's not just he's the Warren Buffett. He's he proclaimed himself to be kind of the moral leader of corporate America, and therefore, if he basically says, I'm not going to vote proxy against the management because I don't want to create enemies, I don't want to upset management, then he just set an example for everybody else, which is very, very sad. And by the way, voting proxy against the compensation is not actually voting against management. It's just basically saying these guys deserve to be paid less, there was nothing wrong with that. So that's what basically happened.
Yeah, I think a lot of corporations drastically overpay their management teams. Maybe it's the management teams who have figured out a way, but the incentive structure of Vitaliy in corporate America just seems out of whack. It seems like, the management teams are figuring out a way to financially engineer high earnings without putting in place the right investments to grow the business long term with new products or services at higher margins and things like that to actually create value for the economy. I think we've gotten away from that as a whole in the U.S. economy. I also think, like Buffett, he just seems to me like his politics, I don't care for them. He seems to me to be a lot more hypocritical at this age in terms of, he says one thing and does another. Like he's been saying that he should pay higher taxes and that other people who have money in the U.S. should pay higher taxes, but then he's doing inversion deals. So it just seems to me like what he said, he's not doing what he says, and I really don't like people like that who don't do what they say.
There was a book written called Even Buffett is Not Perfect. So Buffett just not, he has done a lot of great things for this country and I think for investment community and for investors, for people in general. But he's human, and we just need to remember that. And so he makes mistakes, and that's why he's not God. He's just Warren Buffett. So.
Okay. Well, my last question for you, Vitaliy. You grew up in the Soviet Union. You immigrated here to the United States. Are you seeing a lot more central planning here in Europe, in the United States, when you travel all around the world to look for investing opportunities?
Well, United States is a lot more central planned today than it was 10 years ago, right? Just because the price of money has been set by the, by the government. So obviously you can't compare. There's a huge difference between the United States and Soviet Union. Still a tremendous difference, but it has narrowed over the last, since recession, since Great Recession, because the most important commodity in the world is money, and the government set the interest rate for money, and that's and the Federal Reserve feels like they can, almost like central planners in Russia, by the way, in Soviet Union, they feel like they can they can see the future and they can micromanage the turns, and they have a horrible track record, just like central planners in Russia did. To answer your question, yes, but there is still a huge difference.
Yeah, I mean, there's still some free markets here in the U.S., like especially in the technology sector. There's a lot of good technology companies where there's not a massive amounts of rules and regulations, and you're seeing entrepreneurship and value creation and small businesses grow to large businesses and new products and services and things like that. But there's also a lot of, larger, more established industries here in the U.S., like utilities and food and things like that, where there's just too many rules and regulations for innovation and things like that. And, going back and studying what happened in the Soviet Union, I mean, I'm not saying we're there yet, but I'm saying we're headed down that path, and it scares me.
The some regulation is good, you need to have some of it, but I guess you have to find a middle ground where it's it's the right amount, and finding that line is very difficult. And lately we've been erring on the side of having more than less, and I wish we had a little bit less, but yes.
Yeah, I think if there was less, Vitaliy, I think the real economy, the private sector, would be a lot stronger. There'd be more job growth, and people would have higher paying jobs and things like that. But I think, like, the people that are in power, I live right outside of Washington, D.C., the people in power, they want more rules and regulations and higher taxes and things like that going forward. So I'm not as optimistic about a lot of industries, except for maybe technology at this point.
Oh, okay.
Well, I just want to thank you again for your time, Vitaliy. Please tell our listeners where they can find your work, and if they want to subscribe to your email newsletter about value investing.
Sure. Just go to my website, my company's website, which is imausa.com. imausa.com, and you can find my latest articles there, and you can subscribe to receive them in the future too. So.
Okay, well, thank you again for your time, Vitaliy, and I really enjoyed talking about value investing. It's something I really enjoy learning about, and hopefully we'll have you on again soon.
It's my pleasure. Thank you, Jason.